Last. Yeah. Yeah. Okay, folks, we still have class. Here's what's going to happen. Have your attention, please. Deep and Jake are going to sort the exams in alphabetical order while we finish class today. We have 50 minutes of class. And at 4:45, when I'm done, I will start grading. I have two exams to grade. I have a MBA evaluation class I gave earlier. I'm going to do that class first. It's first in, first out. I will start grading. And when I'm done grading, I will send an email out saying your quizzes are done. You can pick them up. Okay. Could I have your attention, please? Your quizzes are done. You can pick them up. They will be in alphabetical order. That's why I asked you to write your name on the back, face down. The finance department. You have no idea what the finance department. I'll give you specific instructions on how to get there. They will be face down. Don't browse. You know what your last name is. You know where it is in the alphabet. You don't have to go through every alphabet till you get to your last name. Just pick your exam up. I will also send the solutions as I see them with a grading template. And if you have issues, don't take it up with Deep and Jake. They have nothing to do with this carnage, if there is one. Okay? I am the one who grades it. So if you have an issue with the grading, bring it back to me. You don't even have to bring it back to me. Take a picture of the page, say, this is what I had. Your solution says this. It doesn't match up. Yep. Sooner than you think. Now, that's all I can say, right? So you will find out probably so when it comes out. Until then, I will not put the solutions up. Otherwise, you're going to be looking at the solution, freaking out, thinking you've done everything. As I said, I'm looking for reasons to give you credit, not reasons to take credit away, right? Couple of things on the quiz itself. I try not to pick at scabs while they're still healing, but I think I have to pick a couple of scabs on the quiz based on. There's a lot of questions about, is a country an emerging market or a mature market? Why does it matter? What's the only reason we draw a distinction? To get an equity risk premium, right? On problem one, I gave you the equity risk premiums for two countries. Why does it matter whether one's a developed market and the other is an emerging market when you have the equity risk premiums already? That's one. The second, and this is something that I think we should talk about. The third problem, incidentally, you do know there were two versions of the quiz, right? You didn't. Good. Because you saw only one version, that you only matter. So if you put the solution, the wrong version of the quiz on your quiz, we have some talking to do. Hopefully that did not happen because there were two versions. They were exactly the same quiz, but two different versions. So different companies. I think one version got a German company in problem one with a Euro question, and the second quiz had a British company with a British pound, but they were exactly the same degree of difficulty, just two different versions. You're saying that's so sneaky. There's nothing sneaky about it. You have one quiz in front of you. What does it matter to you if there are 5 versions of the quiz, right? So when I send the solutions, I would send both solutions. Just make sure you check against the first. The second question, which showed up in both quizzes, was about a regression beta. I gave an average regression beta. And quite a few of you asked me whether it was a levered beta or an unlevered beta. And you got a very unsatisfactory answer, which was, you got to figure it out. So let's figure it out. What's a regression beta? You run a regression of returns in the stock against returns on a market index, right? So when you run a regression beta, is it a levered beta or an unlevered beta? It is always a levered beta because equity return. So when you have a regression beta, which is what you get from Bloomberg, the raw beta is always a regression beta. Unless you do something to it, no service ever reports an unlevered beta because, so regression beta is always levered. So you're saying, why don't you just call it a levered beta? I wanted to see whether you had made that connection between regression betas. You're saying, oh my God, this is the end of the world. I treat it, it's not the end of the world. Nothing in this quiz is the end of the world, right? Even if you got 0 out of 10, remember you get one freebie. That's a good news. The bad news is you just used it up. Hey. But this isn't the end of the world. So if it happens that you did badly on the quiz, just let it go. If you did well on the quiz, don't celebrate too much because there are 2 other quizzes coming. So that's about all I want to say about the quiz. Are there any logistical questions? Okay. So you'll see the quiz score, you'll check the solutions. If I've screwed up, and I do screw up because, I believe in fast and sloppy grading. And basically just get it through, which means if I make a mistake, it's probably going to be in your favor rather than against you. So don't feel this urge to be completely honest and tell me that I didn't take off a point when I should have. Just let it ride, right? It'll all even out in life. So, so it will be I can make mistakes. If I made a mistake that's working against you, bring it up and I'll fix it. Right? So let's talk about growth rates. We're talking about, historical growth, backward looking, not that useful, higgledy-piggledy. I want you to remember that word, higgledy-piggledy growth for past growth. We talk about analyst estimates, sound great because they're experts, they know these companies, they spend a lot of time on earnings growth, but they're not very good at it. Why? Because their heart's not in it. They're playing a pricing game. They're trying to figure out what the earnings per share will be next quarter, and beyond that, they lose interest. And then we talked about growth coming from what you do as a company, how much you reinvest and how well you reinvest. And I left you with this table saying, look, how we measure how much you reinvest and how well you reinvest depends on what metric you're looking at. If you're looking at earnings per share, you measure how much you reinvest with the retention ratio, whatever you don't pay out, and you measure how well you reinvest with the return on equity. If you're looking at net income, not earnings per share, but net income in the aggregate, you look at an equity reinvestment rate. How much are you as equity investors putting back into the company from your net income to grow? And how well you're investing at capture with a non-cash return on equity. What's non-cash return on equity? You take the interest income out of net income and you take the cash out of book equity. And if you're looking at operating income, I measure how much you reinvest by looking at the percentage of your after-tax operating income that goes in net CapEx, change in working capital, but all the caveats about R&D and all the stuff we talked about bringing into reinvestment. And how well you reinvest with a return on invested capital. Return on equity, return on invested capital are both scary numbers because they're purely accounting numbers. Why? The numerator is accounting earnings. Net income in the case of return on equity, operating income in the case of return on invested capital. The denominator is also an accounting number, book value of equity for return on equity and book value of invested capital. This is the only place in finance where we use book values. Because think about all the times we've talked about debt and equity in this class. We talked about debt to equity for a levered beta, always market value. When we talked about debt weights and equity weights and cost of capital, always market value. This is the only place in finance where we use book values. Why? Because we're trying to get a sense of what you actually put into a project rather than what it's worth today. I want to get a measure of, are you a good manager? If you put in $100 2 years ago and you're making $50 as your income now, that's great that you're making a 50% return. And I want to reward you for that. So with that lead in, let's take a few examples of each of these 3 sustainable growth rates. Let's assume you want to estimate growth in earnings per share. I almost never do things on a per share basis, but once in a while, it's convenient to do things on a per share basis. The growth in earnings per share, we said, is a product of retention ratios times return on equity. I'll tell you the place where I use this approach the most. It's when valuing banks. Banks should have to be equity focused. Often you're doing things on a per share basis. In 2008, when I was valuing Wells Fargo, this is the year before the fiasco in 2008, they had a return on equity of 17.56%. Impressive. And in fact, they weren't the only one. Banks had reported higher and higher returns on equity. We didn't know the storm that was lurking on the other side. We thought, this is good. Banks are really great companies. 17.56% return on equity. And their retention ratio was about 45%. They were paying out 54%, retaining 45%. If you'd asked me to estimate a growth in earnings per share And I was willing to assume that both those numbers, the return on equity and retention ratio, would stay stable over time. The expected growth in earnings per share would be the 45.37% retention ratio times return on equity. That expected growth rate is 8%. In other words, I've taken your biggest weight off your shoulders, right? You're sitting there saying, how do I get a growth for a company? I say, it's already there. Take the return equity. And that's why people like sustainable growth, because it seems like an easy out. I don't have to forecast growth. I just take these two numbers. But remember, you're implicitly forecasting. What are you forecasting? That the return on equity and the retention ratio would stay stable over time. The reason I picked the Wells Fargo example is a few months later, of course, the whole thing came apart. Returns on equity collapsed, earnings collapsed. So the same valuation a year later with retention ratio and return on equity would have been a very different number. So let's stay on this equation. Expected growth is return on equity times retention ratio. What did I say about the retention ratio? What's the highest number the retention ratio can be? 100%, right? So if you believe this equation, your growth can never exceed your return on equity in steady state. So if you have a 30% return on equity, that's the highest number your growth in earnings per share can take. So you want a high return on equity company when you're valuing a company, right? There are two ways a company can end up with a high return on equity. One is to take great projects. So you took Google, Apple, amazing returns on equity, even if you correct for R&D. The other way to get high returns on equity is to do it the real estate way. You know how real estate people deliver high returns on equity? They borrow money. You take an average project, you borrow enough, you return it. I'm not saying it's a good thing or a bad thing, but return on equity can be increased either by taking great projects or by taking average projects and pumping them up with that. In fact, there's an algebraic link between return on equity and how much you borrow. And here's what that link is. If you define the return on capital as what you would make with no debt. So imagine being an all equity funded company. Think of that as your base number. And then you tell me how much you borrow with the debt to equity ratio and what it costs you to borrow money. I have the ingredients to estimate your return equity. I'll take an example. It's a company called Brahma, now called Ambev. It's a Brazilian beverage company. I was looking at it for the very first time in 1998. The return on equity was about 31%. I was impressed. And I remained impressed after decomposing it, but a little less impressed. And here's why. If I look at the return on capital of the company, it was about 19.91%. So with no debt, their return on equity would be 19.91%. They had about 77 cents of debt for every dollar of equity. So they were using a substantial amount of debt and paying only 5.61% on an after-tax basis on it. Think like an equity investor. What are you doing? You're borrowing money at 5.6%. You're making 19.91% in your project. That difference of 14.3% goes directly into your pocket. That pumps up the return equity to 31%. So when you look at your company and you look at its return equity, if it's impressive, that's great, but then break it down. How much of it is coming from taking great projects? So compute the return capital, and how much is coming from leverage? Because that's going to have an impact on how much you value the equity at, right? If it's coming from using a lot of debt, it's going to come with a higher beta, levered beta, higher cost of equity. It's coming from great projects. It's pure gravy. You're going to take it as upside. So retention ratio times return equity is expected growth. Let's move on to non-cash net income and trying to get a growth rate there. Here, things get messier because you can't just take the payout ratio. You actually have to look at what a company reinvests in net capex. Because when you think about retention ratios, I'm assuming that what you don't get pay out as dividends gets reinvested back in the business, right? But that's technically not true. I cannot pay dividends and just hold it as cash. That's very different than putting it into projects. And with non-cash net income, you look at what the company's actually doing. So you look at the net capex, the change in working capital, things you looked up for your free cash flow. So this isn't extra work. You've already done the work to compute the free cash flow. And because you're looking at just the equity portion of it, you multiply by 1 minus the debt ratio with the shortcut. So if you're reinvesting 100 million and 30% comes from debt, the remaining 70% comes from equity. So that's 70 million. You divide that by the net income, you have an equity reinvestment rate. So compare that to the retention ratio. And we talked about this last session. Unlike a retention ratio, an equity reinvestment rate can be higher than 100% if you're reinvesting huge amounts, in which case you're raising fresh equity to do it, or it can be less than 0%. Why? Because your net capex is negative. Your capex is less than depreciation. Your working capital is shrinking. So it's much broader in terms of what it reaches. And your equity reinvestment rate measures how much you're putting back. For the non-cash return equity, I start with the net income and I subtract out the interest income from cash. Where would you find it? Usually in the income statement, right below the operating income line, you'll see the interest income. Take it out of it. It'll be a small number right now for most US companies. But it'll still be a non-cash net income. And in the denominator, instead of dividing by book equity, I divide by book equity minus cash. So I'm looking at only the portion of the equity that's invested in operating assets. Non-cash return equity times equity reinvestment rate gives me the expected growth in non-cash net income. I'm not doing something radically different. I'm just measuring reinvestment and returns differently. So let's try this. And I'm going to use Coca-Cola, I think in 2009 to illustrate this. Coca-Cola reported net income of $11.8 billion in 2009 and book value of equity of $25.346 billion. So if I did a traditional return equity, I'd take the 10 billion divided by 25 billion, I'd get a return equity of about 40%. But I want a non-cash return equity. So to get the non-cash return equity, I took out the interest income, which was tiny, as I said, 105 million out of the net income. And I took out the cash, which was not tiny, 7 billion out of the book equity. My non-cash return equity is 64%. I think that's a much fairer measure of what Coca-Cola is making on its operations than taking net income divided by book equity, because the book equity is such a large cash component to it. The equity reinvestment rate during the year, I took by taking CapEx minus depreciation. There's a change in working capital. And they did borrow 150 million during the year. Remember, I'm looking at only the equity portion. Equity reinvestment of 957 million as a percentage of the net income, it was about 8%. Here's the reality with Coca-Cola. The company doesn't reinvest much. What is it going to reinvest in? It tried, right? And remember in 1986, it tried to come up with a new Coke and old Coke. And finally, it figured out nobody cares what it tastes like. You know, Coca-Cola doesn't even taste the same around the world. When I live in San Diego, I never buy traditional Coke. I buy Mexican Coca-Cola because it uses real sugar. It tastes very different. So this notion that taste is why people like Coca-Cola is mythology that even Coca-Cola doesn't believe. So there's no R&D going on. If you're thinking somebody in Coca-Cola, you have scientists trying to, there's nothing happening. They're just accidentally, if they come up with something that tastes better, they will use it. But all they need to do is pump a lot of sugar in and you're going to buy it anyway, right? And they throw in caffeine, you like it even more. No? So basically, there is nothing reinvested. But even when you reinvest only 8%, normally you say, the growth rate is going to be tiny, right? But here's the reason Coca-Cola is able to show a growth rate that looks material. It reinvests only 8.18%, but it makes a 64% return on equity when it reinvests. The growth rate is 5.22%. That might not seem like much when you're a company that's the largest beverage company in the world and you're able to grow 5%. It's not from huge reinvestment. It's from the fact that the reinvestment is incredibly efficient at delivering growth. So already I wanted to start thinking about growth. Growth can come inefficiently if you're reinvesting large amounts, or very efficiently as it did for Coca-Cola. What's driving it is the answers to those two questions. So here's the last scenario for sustainable growth. Now I want to talk about operating income, and here's the only variation you're going to see. Instead of looking at this, the equity portion of the reinvestment, I'm going to look at total reinvestment, net capex and change in working capital. Instead of scaling it to net income, I'm going to scale it to after-tax operating income. Again, I'm staying consistent. I get a reinvestment rate. Like the equity reinvestment rate, the actual reinvestment rate can be greater than 100% or below 0%. And I'm multiplied not by a return on equity, because now I'm looking at the entire firm. I'm multiplied by a return on invested capital. What's different about return on invested capital? My numerator, instead of being net income, is operating income after taxes. That sounds familiar. That's what we start free cash for the firm calculations with. And in the denominator, instead of using book equity, I take book equity plus book debt minus cash. That's called invested capital. It's a measure of what's entirely invested in the company. Reinvestment rate times return on invested capital is expected growth in operating income. Again, to see the power of this equation, I'm going to go back way back in time to 1999, peak of the dot-com boom. I picked a star of the dot-com generation. Cisco was one of the shining stars of the 1990s. In 1999, the reinvestment rate was 107%. Let me pause right there. When I say the reinvestment rate is 107%, what are your free cash flows of the firm going to look like if you have 107% reinvestment rate? You have $100 in after-tax operating income. You're reinvesting $107, right? Your free cash flow of the firm is negative. You think this is bad. But wait, not only were they reinvesting a large amount, they were reinvesting an extremely high return on capital, a 34% return on capital. So their free cash flow of the firm is negative, but because they're reinvesting a lot and reinvesting well at the same time, and that's really tough to do, I give them an expected growth rate of 36.39%, the product of the two. High reinvestment rate plus high return on capital is rare, but when you find it, you found a magical company. In contrast, take Motorola, not a star of the 1990s, a company that fell off in terms of people liking it. Here's what it had, a return on capital. So when you look at that reinvestment rate and return on capital, you're basically building in the presumption that the company can maintain this. But you're already up there, right? So this is like NVIDIA today. Cisco in 1999 looked very much like NVIDIA today, unstoppable. It provided the architecture for the dot-com boom. It looked amazing. The only problem was it was reaching that wall that every company hits. So if I'd used that number and projected the growth for Cisco, I'd probably have overvalued significantly. I have no shame in accepting these facts. You're always going to make mistakes in hindsight. This would have been a company that you'd have overvalued because you assumed they could keep doing great things. Yep. They had to when your reinvestment rate is greater than 107%, it means that you're raising fresh capital every year to keep going, right? Because the most you have is 100%. You go above 100%, you need fresh capital. In the case of Cisco, the way this showed up is they did a lot of acquisitions. And guess how they paid for the acquisitions? They paid with their own shares. So in effect, they were increasing capital every year. They're bringing in capital. So when you see reinvestment rates above 100%, it's usually a phenomenon of a company growing by raising external capital. Nothing good or bad about it. It is what it is, and that's going to get factored in. That's what the negative free cash flow of the firm tells you. But you're okay with it because your operating income is growing at 36%. Just to give you a contrast, as I said, for Motorola, their return on capital was about 12% during this period. Not bad, right? Reinvestment rate of about 50%. Not bad. But what's not bad times not bad? Not bad. Their growth rate was about 6%, not bad. And this is why when companies chart out plans, if we'd like to grow at 30% a year, you got to sometimes bring them down to reality. You have a 12% return on capital, you're reinvesting 50% a year. You can't grow 30% a year. Those two numbers are income. So it's one way to check companies when they make these unrealistic forecasts of future growth based on their fundamentals. Your question? That, and also as you get bigger, it gets more and more difficult, right? Because remember, when you're a $10 million firm, 107% reinvestment rate might be 10.7 million. You become a $10 billion firm, you're reinvesting 10.7 billion, right? So even if you have great projects, you don't have projects scaling up at that level. And that's exactly what Cisco ran into. Is they became too big to continue to maintain these numbers. Look at the next decade, it was a decade of disappointment because they kept reinvesting like they used to, but the return on capital dropped off. So it's when you think about in economics, the marginal returns of projects, you're basically taking the best projects and you're working down the list and you're starting to get to very average projects at some point just because you're such a large company. So when you look at all those reasons, when those reasons why, it's a fact that you're getting bigger, your star is starting to shine a little less brightly, and it's going to show up as more moderate numbers. So when you look at these two, if you look at the sustainable growth, accounting returns become the stars of the show. And I told you already, accounting returns scare me because the numerator is an accounting earnings number, the denominator is an accounting book value. And it scares me for a simple reason. Everything accountants do, good or bad, affects your return on equity, right? I don't know, do any of you have trouble sleeping at night? You might have last night because of the quiz coming up, but hopefully you'll sleep like a baby tonight. Yeah? But if you have trouble sleeping in general, I think I have a solution. It's a paper I wrote about 15 years ago on accounting returns that was so incredibly boring that I fell asleep multiple times while I was writing it. So if you have sleep problems, just read this paper, you will sleep like a baby. You will never get past page 1. Okay? So it's an incredibly boring paper, admitted up front. So down, it's about 65 pages. And basically, it's about what are the cleaning up things that I have to do to get a better, because if I want to use this number, I have to trust it. So I'll give you some of the things the paper talks about. It talks about R&D and leases. The biggest reason for doing what I do with R&D and leases is because I care about this return on invested capital, right? Because it brings it onto the book equity, the book debt, depending on whether it's leases or R&D, it changes your return on capital. But there are other things that accountants do that can make your return on capital, in a sense, unrealistic. If you're a company and you make a big mistake on a project, take a $10 billion project, you completely screw up 3 years in, everybody, including you, knows you've screwed up. What are you allowed to do as a company? You're allowed to write it off. Accountants do it to the best of intentions. They say it's a bad project, we're going to write it off. What happens when you write off 10 billion? Take me through the accounting effects of writing off 10 billion. First, what happens to your book equity? It goes down by 10 billion, right? You're saying, that's right, you should lower the book equity. But let's say it's 2 years later and I'm looking at this company. What am I going to see? I'm going to see a low book equity. I'm going to divide the net income or the operating income by book value, and I'm going to come up with a high return on capital and think you're taking great projects when in fact you keep writing off your mistakes. So one of the issues you run into with a company that makes mistakes, writes them off, is to get a sensible measure of what their true return on capital is. You have to go back in history and reverse what accountants did, saying, that was a $10 billion mistake you made. I've got to factor that in. Acquisitions, complete nightmare what they do to return invested capital. Because what do acquisitions bring into the balance sheet that is kind of neither fish nor fowl? Goodwill. It's not an asset. What the heck is it? It's a plug variable. What do we do with it? You know how much that section of the paper cost me in terms of mental health? I wanted to ignore it, saying, what is this nonsense? But you can't ignore it because goodwill could also capture growth assets. In fact, I finally came to the conclusion that goodwill has to be broken up into stupid goodwill and sensible goodwill. You're saying, what the heck is that? When you pay for a growth assets of a company, it shows up as goodwill. That's good goodwill. You're showing the growth assets. But when you overpay for a company, that's stupid goodwill. Wouldn't it be neat if companies said, this year we're 15 billion goodwill, and by the way, we want to let you know 5 billion of that was stupid goodwill. We just overpaid. They do actually. They do it after the fact. You know in what form? What are companies required to do with goodwill now once they admit to a mistake? They have to impair goodwill. So if you look at your company and you see goodwill impairment after goodwill impairment, this is a lot of stupid goodwill. The next acquisition these guys do, I'm going to say you guys have a tendency to do stupid acquisitions. I'm going to leave this goodwill in your invested capital to remind me that I shouldn't be leaving my money with you as a company. So when you think of return on invested capital, the mechanics are pretty straightforward, but you need to understand what your company's been doing, what the accountants have been doing. I'm not saying it's an easy answer. I compute this for every publicly traded company, but it still remains a number that troubles me in terms of what it tells me about the future. But it's become this magic bullet to consulting firms and investment banks. You know, you go to an investment bank, they say, what do you think about ROIC? You say, what? Sounds obscene. What is it? You don't get the job. You don't know what a ROIC is. You can't work with us. It's our inside magical word. So when they talk about ROIC, so take this page with you. So what do you think about the capitalizing of R&D on ROIC? Ask the banker back the question. You might not get the job, but at least you get the satisfaction of knowing the guy has no idea what he's talking about, right? The mechanics of ROIC are easy, but there's so many things that can get in the way of computing it right. One final point. All three equations that I showed you work for companies with stable margins and stable returns. So you think in terms of the life cycle, they really work for companies that are mature companies in steady state. Because whenever your return on capital changes, you're going to get a component of growth that's not going to show up in the equation. So let's take a very simple example. In the sustainable growth equation, let's say you have a company with a return on capital of 12% that reinvests nothing. What's your expected growth going to be if your reinvestment rate is zero? It should be zero, right? But what if I told you that this company can expect to increase its return on capital from 12% to 15% next year? When you compute the income next year, will you have growth in the income? You go from 12 to 15%, remember the invested capital stays the same. $12 goes to $15. That's a 25% growth rate you got. It's a 1-year growth rate, but it's coming from improving your return on capital. It's called efficiency growth. Some of you might have mature companies that don't reinvest very much, that have awful returns on capital, but there is this ray of hope. Because if your returns on capital are awful, you can still get growth. If what happens if that return on capital can be improved from 5 to 7 to 9 to 11% over the next 5 years, you can get 100% growth. But it's finite. It's for that period we improve. So when you hear about private equity firms targeting inefficient companies, this is one of the things they hope to do, is improve the return on capital and deliver growth from efficiencies. So I'm going to ask you to look at, in this case, I've got 5 firms. All have the exact same growth rate because we're trained to focus on that number. What's the growth rate? And I want you to rank these companies from a value perspective, the company which has the most valuable growth to the least valuable growth. So all of these companies have growth rates of 10% a year. The first company gets there by reinvesting 20% with a return capital of 50%. The second company gets there by reinvesting 100% and a return capital of 10%. The third company gets there with a 200% reinvestment rate and a 5% return on capital. Mathematically, you might have to multiply those numbers. You're coming with 10% in every single case. And in fact, the last two, in addition to having a return capital on existing investments, have improvement of efficiency growth. Let's start with the easy one here. Of these 5 companies, which one has the worst growth? Which is the company you're going to like say, please stop growing? Yeah. What is it about 3 that bugs you? And low relative to what? I gave you the cost of capital of every company, right? It's 10%. You're reinvesting at 5%. You are growing, but you're destroying value every time you take. If you stop growing, you'd be worth twice as much. Right? Growth is not always good. In one of these companies, growth is neutral. You're growing, but you're really doing nothing. Which company is that going to be? But growth is kind of a, no, it does nothing. It doesn't add to value. It doesn't detract from value. What did I do for company 3 to tell you it was destroying value? I compared the return on capital to the cost of capital. It was earning less, right? So what's the clue you're looking for? You're looking for a company that earns a return on capital roughly equal to its cost of capital. You're growing, but you're adding no value. It's like, remember in foundations or corporate finance, you talked about net present value? When you earn exactly your cost of capital, what's the net present value of every project you take? It's going to be 0. What happens when you take a net present value of 0? You add 0 to your value. I think you can add 100 zeros, 1,000 zeros, or 10,000 zeros. It's still 0. Growth is neutral when you earn roughly your cost of capital. The first company, of course, is the most value-creating company because it earns a 50% return on capital, well above the cost of capital. It's like Coca-Cola. And it can keep doing this year after year after year because it is, in fact, taking it from new investments. 4 and 5 are great. Efficiency growth is amazing, but it's finite. You get it for 1 year or 2 years, but then it stops. So if I were to rank these companies, now company 1 would be at the top of the list. It's pure value creation. Then I'd put companies 2 and 3 because, they are creating value from efficiency growth, but it's short term. And then at the bottom of the pile, I'll put 4 and 5. 4 because it creates no value and 5 because it destroys value. I want you to start asking that question. The next time somebody says, I have a high growth company, they expect you to pat them on the back and say, that's amazing. Be the skunk at the party. Say, okay, that's nice. But what are you earning on your projects? Because if you don't earn more than your cost of capital, you can grow as much as you want. But creating value from growth is difficult because you got to earn more than the cost of capital. So I'm going to set you up for the way I think, because the way the sustainable growth equation is neat. People love it because it's equations. You put the numbers together. It seems like you replaced your need to forecast with something that comes from outside. But it's deceptive because you're still forecasting, but you're forecasting reinvestment rates and returns on capital instead of growth rates. If you have a company with stable margins, stable returns, you can use those approaches. But most of your companies, your margins are changing. They're either going up if you have a young growth company, or they're going down if you're a company that's maturing and approaching decline. So those approaches are not going to work. So I'm going to give you the generic way of thinking about forecasting cash flows that'll work for any company. It involves 3 forecasts. And as you do that, say, this is a lot of work. It's going to be uncomfortable. It is going to be uncomfortable because you're forecasting the future. You're going to start by forecasting revenue growth first. Think about what drives that growth rate. If you're a small company in a big market, maybe your growth rate can be 30% a year. If you're a big company in a mature market, you got to be more careful. So we'll talk about what drives that number because that'll give you the expected revenues over time. Second stop, you're going to forecast what will happen to your margins over time. So you can start with negative margins. You're a money-losing company, but over time, you got to map out what will happen to those margins. We'll talk about why some companies will have higher margins than others, because sometimes the business you're in will drive what those margins will be. I'm going to call that a target margin, not the margin you're going to get next year, but what I expect you to have in steady state, revenue growth margins. And then I tie up the process by estimating how much I will have to reinvest to get the growth you give me. What does that mean? Well, if you want a high revenue growth, you got to reinvest enough to get that high revenue growth. And I'm going to make that connection with a ratio called the sales to invested capital ratio. Those of you who've been working with my FCFF simple Ginzu spreadsheet on all the valuations of the week, which I know all of you have been doing every week. We'll act like we have, right? But no, you have too much. I don't expect anybody to do even a third of them. But if you do a third, you notice the same phenomenon: revenue growth, target margin, sales to capital. What does sales to capital measure? How many dollars of revenues do I get per dollar of capital invested? Remember, we talked about efficiency of growth. The higher that number, the more efficiently you're delivering growth. The lower that number, the less efficient. We pause right there. You've started a company and you ask me to value. And with each one of these inputs, I'm going to ask you whether you want the number to be a high number or a low number. Start a business. Do you want your revenue growth rate to be a high number or a low number? Everybody wants high growth, right? So, okay, I'll grant you the revenue growth. Then you get to margins. Do you want a high target margin or a low target margin? There again, it's a no-brainer, right? You want the highest margin you can. And on the sales to capital, you'd like it to be $100 of revenues for every dollar of capital. So if I let you pick whatever you want, you can make your company worth $1 trillion, $10 trillion, 5 times the size of NVIDIA. So here's what I'd like to at least set up, and I want you to think about, because remember the next phase of this class, now that you got the quiz out, is you got to start working on your discounted cash flow valuation. It's due at the end of this month. It's a while off. But if you haven't started thinking about it, here's the first place you're going to run into. What is my revenue growth? I'm going to give you some of the things that you might want to think about in making that judgment. I'm not a number, but think. The first is you're going to look at what the size of the market your company is in right now. If you're in a big market, you have more room to grow. If you have a small market, you have less room to grow. You're also going to look at the growth rate in that market. So do you see why AI companies now start off with this wind behind them? The market might be small, but it's expected to grow to be an immense market. So when you put in a 50% growth rate, people are willing to accept it as plausible because the market is growing. In contrast, if you're a traditional automobile company and you tell me I can grow at 50% a year, I'm going to say, where is that growth coming from? The global automobile, there are 86 million cars sold roughly every year. It's not changed much over the last 10 years. So you're going to look at the size of the market. So that's the first stop. Second, you're going to look at your company's current market share. So if you want high growth, do you want a company to have a low market share or a high market share? You want a low market share because if you have a dominant market share already, remember the only way to grow in a mature market is by taking market share away from others. A Rivian can have a much higher growth rate than a Volkswagen. It's unfair, but because you have a low market share, you have more room to run. So you're going to look at the size of the market and how much it's growing, your company's market share, The economics of the industry. And let me talk about what I mean by that. Traditional economics, as companies get bigger, they run into challenges. They get the easiest customers first and then start hitting walls. So that's why in most industries, you get a splintering, right? 15% might be a big market share. It's not that you don't want to grow beyond that, it's tough to do. That was the 20th century in most businesses. Not in all businesses. There were some businesses like utilities where, in a sense, the industry economics drove to one big player, which is one reason they became regulated monopolies. But most industries, take steel, you take automobiles, there were 10, 15, 20 different players. Or take the advertising business 20 years ago. Who dominated? There was no dominance, right? The New York Times might have been the biggest newspaper, but it had like a 2% market share because each region had its own newspaper, then you had billboards. And then along came online advertising. It's a very different business. It's a very different business because it's a winner-take-all business. And here's why. You want to advertise as a company. You want to go where everybody hangs out online, right? So if I ask you, do you want to advertise on Facebook or on Snap? There are 3 billion people on Facebook, 100 million people on Snap. The 3 billion people on Facebook spend an hour every day. The 100 million people on Snap watch and leave. You're going to want to be. So if you look at online advertising in the last decade, it's taken over the advertising business. The New York Times is tinier. And 70% of the growth in online advertising has come from Google and Facebook. So winner-take-all business. So when you look at your company, you're asking, is my company in a business which is going to be winner-take-all, or is it, because that's going to determine the market share you give them. And finally, you are going up against competition. You're going to ask, who's my competition? How strong are they? What are my competitive advantages? I struggled with this with Tesla, right? I mean, Tesla already is a big share of the electric car market. But the only saving grace is the electric car market itself is growing as a percentage of the total market. So I have to make a judgment on that. Who's the biggest competitors Tesla faces? The traditional automakers pretty much have thrown in the towel, right? They're not even in the game. It's BYD. And the big question when you value Tesla is, how is this game going to play out? Because it's a global game. Let's face it. When you look at the number of cars sold 10 years from now, the significant portion of those cars are going to be sold in Asia. Why? Because that's where the people are. You got 3 billion people on the continent. You're going to sell far more cars in Europe or Latin America. So this is the game that's going to determine the growth you give Tesla. So I want you to at least think about revenue growth before we start on Monday, because I'm going to talk about margins and reinvestment, and you'll be well on your way to actually valuing your company. So take a look at your company and its market and make your best judgments.